Hey, welcome to Be the Boss of Your Money. I'm Mitch Goldberg, your host. This is a live stream show about personal finance, investing, the stock market. And I like to talk about the stock market because I do think it's fun and fascinating, and the economy and the interplay of politics with the economy and the stock market and the bond market, interest rates. It's all tied together. So many times it happens all the time whenever I talk to people uh, about investing. I get this a lot. I don't understand anything about that. I really don't get that. I really don't understand how it works, why things go up and down. And that's what this show is all about. It's okay if you don't understand. Ask for help. I'm here to help you. And I love to explain things. Uh, I love to teach. I love to share with you my knowledge I've made from doing things that I've acquired, I should say. Knowledge knowledge that I've acquired from doing things right, from doing things wrong, because we learn from our mistakes. But I've also seen lots of other people do things right and wrong, and I learned from it. And after doing this for 32 years, there's a pretty good amount of knowledge in this head, and it needs a way and a place for it all to come out. That's what brings us together now in this live stream. So take a few minutes, check out what we're talking about. And if you have any questions about what we're talking about or personal finance in general, borrowing, spending, mortgage rates, you name it, something financial, investing in your retirement plan, ask me in the comments. I love hearing from you. It's the best part of doing this, okay? Answering your questions, because then I really know I'm delivering value. And that is a great thing. And it's a lot of fun. And I hope you'll join me in this journey. And if you don't mind, give it a like or an applause, a wow reaction, whatever reactions are available to you, depending on which social media platform you're watching from. Um, we are on a couple of them, and here they are. You see the icons over here. And I just, want you to enjoy the show. So far, I see you the man. Hi, Mitchell. Hey, Michael. So nice to see you. And thank you very much for joining me. And thank you for the fine compliment, because you really know that you're the man. All right. Thank you so much. I really appreciate it. So let's roll the intro. And then we're going to get into the topic today is investors have this horrible, terrible, unhealthy obsession with what Jerome Powell, the chairman of the Federal Reserve, about what he's going to say tomorrow in a big conference that people are like living and dying on. And the fact is, 5 years from now, 3 years from now, we're not even going to remember it. We probably won't even remember it a week from now. So let's roll with the intro, and here we go. Okay, thank you so much for joining me. We're just getting started. I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money. It's all about personal finance, investing, and helping you to become the best possible of yourself. Okay, so what is the deal? Investors have this terribly unhealthy obsession with Jerome Powell and what he's going to say in less than 24 hours. But it does forget what he's going to say tomorrow. Just anytime Jerome Powell speaks, people stand up, or at least they lean forward and they listen. So let me go back a little bit. Who is Jerome Powell? Also known as Jay Powell, also known as Jay Powell. He is the chairman of the Federal Reserve Bank of New York. That's the central bank of the United States. And the central bank has two big job functions. The first, and just as important as the second, the first is to keep inflation steady. Nobody said in the Fed's charter, in its original organizational paperwork, that its goal is to keep inflation at 2%. Right now, it's like 8.5%. Okay, that means prices generally year over year are going up 8.5%, which is a lot. The Fed has stated that it has a goal of 2%, but that's what the Fed stated. It's not actually like in the original charter of the Federal Reserve. But keep inflation steady. That is a big part of the Federal Reserve. The other thing is to keep um, unemployment low, maximize employment. Okay. So those goals are sometimes counter to each other because if there's excuse me, if there's high inflation and if the economy needs to be slowed down by the Federal Reserve, that could raise unemployment. It could hurt. It could hurt labor. So the dual mandate of the Federal Reserve is not always congruent. It's often uh, each goal is in contradiction with the other. So the other thing is that there is no known unemployment rate that the Fed's shooting for. Like it was never in the original Fed charter that the Fed would have to go for 2% inflation rate, okay, or 4% unemployment rate. It just said low unemployment with steady inflation. Uh, it, you would think. Well, I wonder if the Federal Reserve will ever give up on its 2% target of inflation. Maybe it should be 3%. Maybe it should be 4%. Maybe they should say we don't care anymore and just let the market do what the market does. That's probably not feasible and it's probably reckless. However, the Federal Reserve makes these decisions and it raises interest rates and lowers interest rates. I'm talking short term interest rates accordingly. So when it raises short term interest rates, it's presumably to make borrowing money more expensive. I say presumably because it doesn't always work out that way, but generally speaking, the Fed raises rates, makes borrowing, or as we also call borrowing, the cost of money or the cost of credit, more expensive, which then in turn slows the economy, brings down inflation. And that could also raise unemployment. The unemployment rate could go up. Sometimes the Fed overdoes it and we go into a recession. And sometimes the Fed gets it right and the economy slows down enough to bring down inflation without going into a recession. And that's what we call a soft landing. If we go into a recession, it's called a hard landing. And we debate this endlessly. All day long, every day, you put on financial news. This is the big debate. And really, it doesn't matter. And I may be the only person you will ever hear say this. Whether or not we have a hard landing or a soft landing, on the aggregate, won't really matter. It might matter to your situation, and let me explain. If we go into a recession, how does that impact your income? Do you own a business? Does that mean your business revenues will go down, and the business will make less money, which means you make less money? Do you have to lay people off, or are you an employee of a company? And if there's a recession, will your company eliminate your job? So that's on a personal, aka micro level. But you need to make sure you're prepared for up economies, for strong economies, and weak economies. So, just a side note, how do you prepare for that? By making sure you have money saved in emergency funds. So, if you lose your job, you have money to live on while you're looking for a new job. We could get into a whole show about emergency funds. Okay. The other thing you need to do is make sure that you are a value in the workforce. Are you going for new certificates, new accreditations? Are you going for training? Are you willing to pay for these things out of your own pocket? Were you so stingy that you're just going to say, I'm not paying for any new advanced certificates. I'm going to let my company pay for it. If they don't pay for it, then I'm not going to do it. You're only shooting yourself in the foot when you do that. You need to be the one who's pushing yourself for continuing education. And then you need to demonstrate that on a resume and on LinkedIn so that a future employer will see that you are a go getter and a valuable person. Okay. Someone said to me, instead of trying to um, be successful, you should actually try to be valuable in order to become successful. Okay, so let's see who else is out there. Jerry, my man. Jerry, you are such a good friend. Hey, Mitch, keep up the good work. Yes, sir. Thank you very much. Really appreciate that. You are just man, oh man, always such a good friend. Thank you very much. Really appreciate that. And you too, Michael. Thank you. Okay, so let's go on. So we're talking about the Federal Reserve. Jerome Powell is the chairman of the Federal Reserve. So what he says, what he does, has a massive implication on markets. It's really one person who has control over so many things. All right. So having said that, Jerome Powell has definitely. Oh, wait a minute, a new person on the show, Howard. Great to see you, man. Really enjoyed lunch. Howard, I enjoyed lunch with you too, man. I really enjoyed our conversation. I really enjoyed our kibitzing and learning about you and just finding things we have in common. And you're just a very comfortable, easy person to spend time with, a true joy. And I hope to see you again soon. And I hope you sent me a request to be friends on Facebook as well. We should definitely be friends there too. So let's take a look at Jerome Powell. He is at a conference now in Wyoming. Jackson Hole is a rural town, I guess. I haven't been there. Jackson Hole, Wyoming. And it's the Federal Reserve Banks Symposium where central bankers from all over the world meet. And it's not just central bankers of countries, it's bankers of public banks like JP Morgan, Citigroup, like banks from all over the world. There's probably politicians there. There are heads of industry there. It's the money control people of the world. And they're talking about economic stability. They're talking about inflation. They're talking about employment. They're talking about all of the big, in broad strokes, economic policies that every country has to take or should take, etc. It's a big deal. It's very prestigious to be invited to this event. I have not been invited yet, but I'm available to go next year. So Jerome Powell, who's the most powerful central banker in the world, because the Federal Reserve is a central bank of the United States, which is the biggest economy in the world. Jerome Powell is making a speech tomorrow. And investors, it's all they could talk about for the last couple of weeks. What's he going to say in Jackson Hole? And every pundit you see on TV is like, we're not out of the woods yet. We still have to see what he says. There's still things to do with. There's still high inflation. The Fed needs to see, 3 months of inflation moderating. We're not out of the woods yet. We're not out of the woods yet. It's however way you want to say, which I think is a joke, is we're never out of the woods. So everyone is hanging on, investors are hanging on to whatever Jerome Powell is going to say tomorrow. It's like life and death. It's like whatever he says is going to be the determination for my net worth, for my future, for my financial security, for everything, forever. And it's just the news of the day in a generally slow news time because we're toward we're almost up to Labor Day. And it's just a very slow time, light trading volumes, a lot of people on vacation. I could tell you the office building that I'm in, the suburban office building, the parking lot has been empty for the last week, and it'll stay that way next week also. But that's all it is. It's just this unhealthy obsession with Jerome Powell and what he's going to say. And he might say that the Fed has a long way to go in raising rates, and we're not as close to the end of the rate hiking cycle as we thought. Or he could say, we're closer to the end than the middle, within the beginning of the rate hike cycle that we're in. And that would be very bullish for the stock market. And, bullish meaning positive, a positive thing. It would send stocks higher. If you're not familiar with the inside baseball language that we use every day, and I want to explain that to you. That's all. All right. Maybe he'll just say things are balanced. But people are trying to figure out what Jerome Powell's plans are for interest rates going forward. But we know for sure, not knowing what he's going to say tomorrow, we know for sure that he has changed his mind in the past. He says inflation is transitory. Now he's raising rates faster in a rate rising cycle. He's raising rates faster and more than any other chairman of the Federal Reserve in history. And then a few weeks ago, he said something that was kind of moderate. And then he comes out and says, no, 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 we're raising rates more. We've got to keep the pedal to the metal. And he's data dependent, meaning that as new data comes in, he could change his mind. Some people say that's bad. Some people say it's good. As new information comes in, you should be flexible and change your mind. Some people say it's bad because you can't really make investment and economic plans when you don't really know what the Fed's going to do. I say, as far as investment plans, that's BS. Investment plans means investment planning. You invest, you wait, and then one day you begin to sell at higher prices, hopefully at higher prices, to pay for your bills when your income starts to drop or goes away when you retire. As Howard Douglas, who I had lunch with today, said, my job is not to make you rich. My job is to prevent you from becoming poor before you die. It's a great expression, and he lives it. So you could tell he's more from maybe from the insurance side, and I'm more from the investment management side, right? But you have to use the two. You have to balance risk with reward. So I think investors are making such a big mistake by focusing so much on Jerome Powell, what he's going to say at Jackson Hole. Whatever he says, this is not going to determine the rest of your life. It's just one day, one speech, and new data comes in, new economic data comes in, and he'll change his mind and he'll say something else. I don't make plans in my life based on what Jerome Powell is going to say tomorrow and then what he might or might not say a week after that and a week after that and a week after that. I dollar cost average, I invest cash, I wait. All right. These are the things that you do as an investor. The rest of the stuff, I guess if you're a hedge fund and you're day trading, might mean something. But all of this stuff is nonsense. And I want you to tune it out unless you're really interested in learning about this stuff that we're talking about. I want you to know it doesn't really mean anything. You're throwing your money into your retirement plan, you're investing in your retirement plan, and you're waiting 10, 20 years or more. What the heck does Jerome Powell have to do with this tomorrow? What he's going to say tomorrow? What, the market's going to go up or down 700-800 points tomorrow? It could. Means nothing to you, means nothing to me, because presumably you have taken money out of the stock market and put that money into something more stable because you need that money over the near term and intermediate term. So you don't have to worry about what your long-term investment money does in terms of going up and down. And these things are all a function of your age, your overall net worth, your expenses, etc. Then we get into more investment planning and financial planning, but that's the gist of it. Okay, let's take a look at how things did today because we had another update in the market. Let's do that. Let's get rid of that. All right. So the Dow today, I'll plot myself up in the corner. All right. So today the Dow is up 300 some odd points, continuing a little move up from yesterday, helping make up for the week earlier the week losses. The market's major average is still down for the week. NASDAQ up 200. That's a big day. S&P up 58 points. Not a bad day for that either. Gold up a drop. Oil down to 93. 10-year yield went down a little bit to 3.02%, but still above 3. The VIX still hanging out in the low 20s. I think that's bullish. Some people disagree. Some people think it's negative. I think it's a good thing. Bond market yields were, fractional tiny moves in the short end. That means 1 month to 6 months, 1 month, 3 month, and 6 month CDs. But the longer end, 10-year, 20, 30-year yields were down a little bit. But the thing that I want you to take a look at are two things. See this here? Okay. The let me see if I can just highlight this one. The U.S. Oh, it's not. There we go. The mm, anyway, see where my cursor is. The U.S. 2-year, 10-year spread is still 35 basis points apart. It narrowed a drop today, but that means that when you invest longer term and think of like in bonds or CDs, the longer out you go, the higher your interest rate would be. Sometimes it gets flipped, and right now, the shorter term yields are higher than the longer term yields. It's an inverted yield curve. It's a sign of a lack of confidence in the economy, and that we're possibly going into a recession, possibly in one. Okay. So that's still negative inverted yield curve, and the 30-year fixed mortgage is still above 5.5% at 5.81%, so pretty high. Those are much more important things to me than what Chairman Powell is going to say tomorrow. And what were the winners? Winning sectors. Let's get rid of that. Winning sectors. Materials were the winners of the day. So economically sensitive stocks did well. XLC was up. Communications, that's big in for Facebook and Netflix. Technology was up. I know what you're thinking, but is it Netflix and Facebook? Technology? No, according to the world of S&P, they're in communications. Financials had a pretty decent day. That's important. XLI has had okay day. XLI right here. That's the ETF that tracks industrials. Okay, consumer discretionary. Overall, it was a good day for everything. All of the 11 major sectors were up today, from consumer staples to consumer discretionary, okay, to building materials, etc. So it was an overall pretty good day in the market, and I think investors have already worked into their plan short term that Powell would say something that would be negative for the stock market on Friday. And then as we get into yesterday and today, today's Thursday, so whatever, investors are starting to get comfortable that whatever Powell says, it's factored into the market. We could see an upside surprise though, and he'll say, "Hey, I don't want to raise rates that much anymore," and stocks will start to go up. But anything can happen. I'm not a Powell mind reader, neither are you. So let's just keep on investing and controlling the things that we could control, and that's all we're going to do. So what's the expression I like to use? Trust the process, surrender the results. I'm going to get going. We've got a couple of calls to make. Thank you so much for watching. I hope you enjoyed the show. And please always remember to tune in. I go live typically around 4:30 every Monday through Thursday. I skip Fridays. Unless there's some calamity in the market, I won't be doing a live stream on a Friday. And again, if you'd like, give us a thumbs up, a heart, an applause, whatever reaction is available to on social media. It helps spread the good word of the work that we're doing here. And I'll see you soon. Thanks so much.